difference between a fixed rate and an adjustable rate mortgage. A fixed rate mortgage has an interest rate that stays the same for the entire length of the loan. So your principal and interest monthly payments stay consistent. This can make it easier to budget because you'll always know what you'll owe. An adjustable rate mortgage, or ARM, works a bit differently. It starts with a lower fixed interest rate initially, typically 3, 5, or 7 years, but after that, the rate can change at set times, typically annually, depending on the market index that it's tied to. That means your monthly principal and interest payments could go up or down in the future. People often choose ARMs if they plan to move or refinance before the rate starts changing. The main difference is that fixed rate loans offer stability, while ARMs offer lower starting rates but have more uncertainty later on. What is an FHA loan? An FHA loan is a type of mortgage that's insured by the Federal Housing Administration, which is part of the government. It's designed to help people who may not have perfect credit or a large down payment still be able to buy a home. With an FHA loan, you can usually qualify with a lower credit score and a down payment as low as 3.5%. These loans are popular with first-time homebuyers because they make it easier to get approved. However, they do require mortgage insurance, which adds to the cost of the loan. This insurance protects the lender in case the borrower can't repay the loan. What is a VA loan? A VA loan is a type of mortgage backed by the U.S. Department of Veterans Affairs. It's available to eligible veterans, active duty service members, and some members of the National Guard and Reserves. One of the biggest benefits of a VA loan is that it often doesn't require a down payment or mortgage insurance, which can make buying a home more affordable. VA loans also typically offer competitive interest rates and more flexible credit requirements. The program is designed to help those who have served the country become homeowners. And while the VA guarantees the loan, it is still issued by private lenders like banks or mortgage companies. What is a conventional loan versus a government-backed loan? A conventional loan is a type of mortgage that is not insured or guaranteed by the federal government. Instead, it is offered by private lenders such as banks, credit unions, or mortgage companies. To qualify for a conventional loan, borrowers typically need a higher credit score, a steady income, and a larger down payment compared to government-backed loans. On the other hand, a government-backed loan is insured or guaranteed by a federal agency such as the FHA, Federal Housing Administration, VA, Department of Veterans Affairs, or USDA, the U.S. Department of Agriculture. These loans are designed to make homeownership more accessible, especially for people with lower credit scores, smaller down payment, or special eligibility like military service or rural residents. The main difference is that conventional loans rely solely on the borrower's financial profile, while government-backed loans offer added protection to lenders, which can make it easier for some borrowers to qualify. What is a jumbo loan and who needs one? A jumbo loan is a type of mortgage used to finance homes that are too expensive to qualify for a conventional loan based on limits set by the Federal Housing Finance Agency, the FHFA. These limits vary by location but generally apply to loans over a certain amount. Currently, it's around $766,550 in most areas, though it can be higher in more expensive markets. Because jumbo loans exceed these limits, they aren't backed by Fannie Mae or Freddie Mac, which means they come with stricter requirements. Borrowers typically need a high credit score, a large down payment, and strong income and financial documentation. Jumbo loans are often used by buyers purchasing luxury homes or properties in high-cost areas where home prices are well above the national average. What is Fannie Mae and Freddie Mac? Fannie Mae and Freddie Mac are government-sponsored enterprises, referred to as GSEs, that play a key role in the U.S. housing finance system. Their main job is to buy mortgages from banks and other lenders, which helps those lenders free up money so they can offer more loans to other homebuyers. After buying these loans, Fannie Mae and Freddie Mac bundle them into mortgage-backed securities, which are then sold to investors. This process keeps money flowing through the housing market and helps make mortgages more available and affordable for borrowers. While they don't issue loans directly to their homebuyers, their influence helps set standards for things like credit score requirements, down payments, and loan limits for many conventional mortgages.